All right. So coming to the continuation of our classes, I was just suggesting because I think maybe network will be a little bit bad today, so I decided to just make a video at once and send it to you guys at least because today we'll be entering into more of the market structure and market shifts. Um, these are the main component confluences of internet, right? And whenever I want to enter these are things that I want to consider, I want to put to consideration before entering into any trade. Number one is we have learned about market structure. This is how the market goes, the uptrend, downtrend, consolidation, and all the rest. But today, since you have talked about it on the other class, but I just want to give a brief introduction about this market structure and break of structure. Um, First of all, market structure is this, as we have learned before that market in an uptrend, market do goes like this. They will be making use of an uptrend for this class, and goes like this. Then this is what we call market structure now. Then you can see I'm trying to do something with this trend line here. This is how market works. Then what is now market structure? You know, whenever a market is in an uptrend, there is something we call um this is a bullish order flow. So how to identify your break of structure? Break of structure is whenever the market makes a new high. You can see, and over here we have another break of structure here. You can see, and if you continue this range in an uptrend, this is a continuous range of an uptrend where market is making a higher high, higher low, higher high, higher low. So for you to um confirm that you're in an uptrend, and whenever a market, what you have to understand is whenever a market makes an uptrend, wants to continue in an uptrend, maybe it steps into a demand zone and push the price up, then the market has to come back. This is an impulsive move, and maybe they just use let's make use of imbalance. Here the market makes a very big move causing an imbalance, then it has to go way here down here to make to balance the structure. Then once the market balance the structure, then it has to go up and take out the old high. And whenever it's taken out the old high, you can see it has broken the former structure and creating a new high. And market has to go back and retest that structure that it broke. And once it retests it, we have had a break of structure and a structure retest. Here is a structure retest. Here is a break of structure where the market took out the old high, and here is we have here a market a break of structure retest. So this is how the market. This is a bullish order flow. Then this is just vice versa. Then what when we want to talk about um market shift, that is when we see something like this, when a market is making something like a Fed reaction. What do you mean by Fed reaction? Maybe market step into a demand or supply zone, or let's just say a demand zone because you're making use of an uptrend, and market steps into a demand zone. Then the demand zone, maybe let's just use something like the demand zone was here. Here was the demand zone, for example. Then the market failed to push the price way up. Maybe the price wasn't able to take out the old high. Yeah, that's what I mean. When the price failed to take out the old high, maybe we'll be having something like this. Okay, let me just redraw this. Maybe here there is a demand zone. Maybe the market was creating a new high here. Whenever it steps into a new demand zone, something like this, and if you come back, break the structure, retest it back, then you can see maybe market stepped into a demand zone and failed to push the price way up, and it has to come back here and break the structure. You can see the structure has been broken. Then what do you expect now? You have to wait for the market to enter into a flip zone, but we are still progressing on that. I will even teach you guys what a flip zone is all about. But for now, let's just focus on this market shift. You can see this is a fair reaction, like when a this thing Let me clear this for better understanding. When a demand zone failed to create, maybe let's just use when a market, for better understanding, when a market failed to create a higher high and therefore taking out, maybe reversing on the trend. Yeah, here is the point of interest that we'll be looking for, because whenever market creates something like this, we'll be having something. When market failed to take out this high, let's just say we are in an uptrend and market failed to take out this high. What do we expect next? We expect the market now, and maybe and market took out, maybe just took out the lower low, the higher low, maybe causing the market to price to change like this. What do we expect? We expect the market to make some move like this. First of all, after taking out the first high, sometimes it is used for liquidity. That is where liquidity concept comes in. But sometimes you have to wait and take a good advantage of a reversal trend. We have to wait for the market to make this as in take out our old higher low, then come back to this flip zone. That zone that caused the market to shift. That is a flip zone, either a demand flip zone or a support flip zone. And we have to wait and take a trade from there. But most especially, once this thing is taken out, here is our market shift. Here you can see I like to make use of MS for market shift. This is market shift. Here is a market shift because market has changed from bullish to bearish, and here we'll be looking for a sell opportunity. Now, when do we look for this sell opportunity? We have to look for a sell opportunity around here. Here, the high that were created, we have to look for a supply zone that were created here. Around here, you have to wait for the market to come back all the way up here and then start to push back. That is where we look for a reversal trend. Then for your risk management, then let's just be going into, I want to make this class to be snappy. Let's go into risk management. So what do I mean by risk management? Risk management is just about how you manage your trade. Number one, how the kind of lot size you make use of and all the rest. Like for example, you are holding your account of, let's just say $100, and maybe let's just say you're a newbie and you don't have much with you. Then you want to be risking $10 per trade. For example, like a good trader, if you want to be risking like $10 per trade, that is to say making a use of 0.01 loss size. And another thing about risk management is your risk reward ratio. Your uh, risk reward ratio. This goes a long way to help trader. Maybe let's just say you have a trade today, you took about, let's just say you took um 3 trades today. Let's just say you took let's just do mathematics a little bit. You took 3 trades today, a day per day, and they are making, let's just make use of, you are using a constant risk reward. Let's just say we are risking $10 to make $20. That is to say, and you lost, okay, let's just make use of four. Number four, let's just make use of four. Maybe you took 4 trades a day, you took 4 trades a day. Now, you taking 4 trades a day now, let's just um check this and see how profitable making use of risk reward is. And you were risking $10, then let's just say you lost 2 trades out of the 4 trades that you took for the day. Let's just check it out. You lose 2 trades. You lost 2 trades, causing you 2 trades. You lost 2 trades, causing you now you can see something. Let's just say a day you took about 4 trades in a day in a row. 4 trades a day. I think for a beginner, a 4 trade is good. At least three, maybe one in the morning, one in the afternoon, one in during evening time. Or once I don't take trade based on anything, but once my setup sets up, like everything I'm looking for, my market structure, my market mechanics, like other blocks and all the rest. Once it is set up, then I'll be looking for a position. But at least I make sure that each day that I trade, I don't trade above 3 to 4 trades a day. So let's just look into this risk reward ratio. Let's just say you're making use of a risk reward ratio of 1:2. Okay, two risk reward ratio, that is you're getting two to make, you're using one to make two, something like that. Let's just say like this. This is a risk reward ratio calculator. You can see risk reward ratio. Then you need to say you took 4 trades a day. Then you, in the midst of these 4 trades that you took, each one you're risking $10, and the other one you lost about 2 trades, making you to lose $20 for the 2 trade. Then the other 2 trade was profitable. You made about $20 20 USD per trade. Then you can see that you have about $40 profit. Then minus the $20 from the uh 40 USD profit, you can see you're still profitable. That is why risk reward ratio is very, very important, and that should be your number one risk reward. Also, about checking risk reward ratio, what you have to know is that whenever you want to enter into a trade, you have to check your risk reward ratio. Maybe making use of this indicator. You can just find it in your my trading view. You can just see, if you look down, you can just see it. I think it is here, around here. Forecasting and measurement, you can see it here. Just put it to your favorite so that it will be available for you to make use of. Then once you want to take a trade, let me just say you want to take a trade, you just have to apply it. Okay, for example, let's apply it to our chart now. Let's apply it to our chart. Let's apply it to our chart now. Let's apply it. This is a gold chart for today. Then I was doing some work on it. Let us say once you enter a trade, you are willing to reach $10 to make $20. What you just have to do is come over here. Then your entry point, put it like, let's just say you are going long on this trade, for example. Then you put it here. Just check where your stop loss, maybe your stop loss, you want your stop loss to be right here. You leave it there. Then you have to shoot until, like, you have to shoot 2 to something like this for this trade, for this particular trade. You just have to check it like this. You can see it's to 2 to 20. That is, you're risking $1, like you're risking one to make 2.88 USD, like two times your risk. This is 1:2 risk reward ratio. You can see it over here. It's very good because once you're making use of a risk reward ratio that is like this, at least even if you take like let's just say 6 trades or let's just say 12 trades in a week, and you lost half of it. Let's just say you're making 60% sure, you're very, very 60% sure of the strategy that you're making. So you see that at the long run, because trading is a journey, it's not just something like let's just say trading is a career. You can make trading as a career. Then maybe you lost 6 trade among these, and you still have about 6 trade profiting. You see that you are way more in profit than ever. That you are way more in profit when you are making use of a 1:2 risk reward ratio. So that is one, you're risking one, your reward should be two. So now whenever you hit your take profit, then you know that you're making, maybe you're taking okay, let's just say even if you lost 2 trades in a day, that is you're staying at a middle, like you're staying, maybe let's just say you haven't lost much. Even if you lost 2 trades in a row, then one profiting trade will just recover all these 2 trades that you lost in a row. So that is just the importance of risk reward. So I hope all of you should be applying your risk reward ratio. Then moving over to stop trade management, many people doesn't teach this, but as with experience, advise you to, not every time you open, you can see some trade doesn't have the same setup, and sometimes trend doesn't move in the same order flow. So what you have to do is that once you are into a trade, leave those gurus that will tell you that once you're into a trade, just place it, leave it, anything you want to become. No, you have to manage your trade. Maybe let's just say you enter the position over here. Let's make use of this. You entered a position over here, for example. Then you can see this trade went all the way up here, giving you up to let's just say here is almost 1:5. That is 1.5 of your risk reward. What you have to do for to manage this trade properly so that you won't get heated out, maybe the price reverse and hit your stop loss. What you just have to do is you just have to move your stop loss. Maybe your stop loss was at 24.03, then you just have to move it to break even. That is what you mean by break even. Then add it some little profit that you'll be okay even if price come back reverses reverses against you. You just have to take a little bit profit out of the money that is being made. That is how to manage your trade properly. And another thing to manage your trade properly is just knowing where to put your take profit and stop losses. That is very, very crucial and most important part of trading. Knowing where to put your stop losses and take profits in a market. So, how do you know where to put your take profit and stop losses? Okay, there was okay, you can see currently this was a chart that I drew. This was a supply zone. I mapped it out, and although I didn't take this trade because the market was just, I was very very busy with something. Then you can see I drew after market reached this demand zone and bounced off. I drew out this supply zone, which I know that market is mostly going to mitigate. So you can see market reached there and bounced back a little bit before continuing the uptrend. That is where to, because you don't want to put your stop take profit maybe where the market will not reach, maybe the market will reverse against you or go back at your disfavor, something like that. So it is very very crucial to know where to put your take profit and stop losses. And how do you identify that? By identifying unmitigated supply and demand zone. Supply and demand zone is just where a supply zone is where there is a lot of momentum, there is a lot of sellers momentum, sellers coming into the market to push price down. That is what we mean by supply. And demand is where point of interest where buyers are interested in, big banks are interested in buying this. We are just speculators of price. You don't have the power or the strength to move the market any way that you want. But these big banks are the big guys, they are the big guys, and it's better to trade with them than trading against them, because trading against them would be very, very, very bad to your account. It might even end up blowing your account. What do you mean by this is a demand? You can see price came down here. The big banks were interested in this demand zone. You can see I drew it out. That should be a bigger demand zone at the 4 hour time frame. 4 hour time frame. And it's also, yes, you can see it was a supply zone that turned to a demand zone. You can see price came back, broke it, and went down, down, down. You can see price went down and came back here, retested it and went and moved. You can see the kind of momentum that was here. Here, you can see went all the way down. Then it came back again and retested it and went back down. Then gathered momentum to break it out. And you can see I mapped it out and price went exactly there. Although it was just it want to touch this break of structure retest. It was just doing break of structure retest and made it to reach here. That made it to reach here. You can see it here. So and now price is now ready to pull up. Then what you have to do is just identify your supply zone so that you don't want to put your take profit where price won't reach or something like that. Then what you have to do is that you can see I have a supply zone maybe in the 1 hour time frame where price is likely to retest. You can see there was a very very big momentum of sellers here, so price will be likely going to be respecting this supply zone, and you can see here has been already be respected, and price is now stepping into this supply demand zone and turning it into a supply. This was a supply zone, and price is now turning into a demand zone, and price is going to skyrocket here again, creating a break of structure number one over here, creating a break of structure which will confirm to us that we are still in an uptrend, and then price is going to hit to reach up to here, then maybe come back here to retest this break of structure before continuing its way up. But you have to be careful because sometimes this supply zone might be stronger enough to reverse the trend. Maybe this supply zone was very very strong and active. Maybe it can have the momentum to revise the trend, and you can see an unmedicated order block at this level. And see here, exactly here, there were very large amount of momentum, and also you can see that price didn't. Okay, let me just zoom in for you guys to see it more. Where you can see this is an order block that price didn't return. It didn't just mind it, went all the way straight down. So we are going expecting price to potentially reverse. Everything is possible in trading. Price might reverse at that point. So that is how to trade, manage your trade and your risk management, your market shift, and all the rest. So our next class, I'll continue with the teaching.